Do you want to buy more investment property, but you're having problems qualifying for the mortgage? Well, I have a solution for you. It's called a DSCR loan. Now, DSCR stands for Debt Service Coverage Ratio Loan, and it's a kind of mortgage that has offered a lot of solutions for a lot of different kinds of investors. So you might be a homeowner.
You must be the new owner.
You want to buy that one extra property for cash flow. Or you may be an experienced investor and you're adding your third, fourth, fifth, 10th, or 20th. Or you might be in the multifamily. And a DSCR loan solves a lot of those issues by offering an alternative form of documentation, which is the cash flow of the property. So essentially, if that property cash flows above a certain amount, then it qualifies. And there's no income documentation at all. So no W-2s, pay stubs, LLC tax returns, personal financial returns, like nothing. There's no income documentation at all from you personally or from your business. It's all about the cash flow of the property. DSCR loans also offer help for larger kind of loans and also some certain property types, which are usually problematic for other financing types. My name is Emmett Dempsey. I'm a mortgage broker here in Florida, and I help families and investors with their mortgage needs. And I'd like to help you guys next. If you would, just go ahead and leave a like in this video. I'd really appreciate it. It helps YouTube know that this content is valuable, and how it helps us get found by more investors just like you. And if you would, just go ahead and leave a comment down below. Let me know how experienced an investor you are. Have you ever heard of a DSCR loan? I'd love to hear your thoughts. With that out of the way, let's go ahead and talk about DSCR loans. Okay, so how does a DSCR work actually, and how is it underwritten? What are the guidelines? So essentially, we're going to break it down into the DS part and the CR. So debt service part, we'll talk about first. The debt service part is relatively simple. So when you do a mortgage, they look at the PITIA, or the principal, interest, taxes, insurance, and association dues. First, we establish what that property is going to cost. So that we got to figure out how much debt to cover, debt service coverage ratio. That's kind of how it works. So let's just say hypothetically, the expenses on property are $1,000. Okay, so a nice round figure. So we establish that the PITIA is $1,000. So let's start there. So next we establish the CR part, our coverage ratio. So how is a debt covered?
Debt to equity ratios.
It's covered through cash flow, right? So that's kind of why you're buying this in the first place. You're generating property, you're generating cash flow. So how do we establish a cash flow? Do we just kind of just make up a number, or knock on the door and call the neighbors? Well, sort of, and maybe a little bit, but you don't do that. So there's a couple ways that we do it. So what we do is when we order the appraisal, there's an add-on called a 1007, and that's a rental appraisal. So the appraiser will do an add-on. Will establish to local leases about what a property like that would rent for in the market. So he does a market analysis. Instead of the value, he does it for the rent. Okay. There's also alternative forms. There's for third-party trusted websites like AirDNA. So if you're buying for Airbnb or you're buying for short-term rentals, they can use that income, which is usually higher, in order to qualify. Okay. So what does the debt service ratio need to be? So there's a golden ratio, basically of 1. So basically, say we have $1,000 of expenses, you want at least $1,000 in rent income to offset it. Now, there are some situations where, especially for larger properties, for like 0.8 is probably about the lowest that I've seen. But generally, they like it to be 1 or more in order to cover the debt. So what are the guidelines? How do you qualify for a DSCR loan? So essentially what you do is you do a same loan application, but we just take the income piece out of that application. But ultimately, you have a credit score and assets. Now, the thing about a DSCR loan, you do have, it has minimum credit scores, usually as low as 640 I've seen. But obviously, the higher the credit, the better your terms are.
Here are the terms.
So the less you need to put down. Generally, it's about 25% down, 20, 25. I think as little as I've seen some investors, it's 15, but in very have higher DSCR ratios. But ultimately, it's right around 20, 25% down. And they generally can have some assets called reserves. So there's the assets you use for the cash to close. The reserves are what's left over after. So some investors will do as little as 2 to 3 months. Some want as much as 6 to 12 months. So it all depends on the investor. Of course, the more stringent the guidelines, the better the interest rate. So it's kind of a sliding scale. Also with a DSCR loan, you're able to refinance. Say that you've acquired a portfolio of rental properties over the years and you have hard money on them and you need to refinance into something better. So a DSCR loan would be, you can do the entire portfolio in those, and a DSCR loan would be a great solution in order to get out of that hard money loan or a balloon or something of that nature. You can use a DSCR loan to refinance all those properties and get cash to buy more rental properties. And also there's no limit on the number of properties that you can buy. I know, because even if you had perfectly documentable income with your tax returns, you're limited by Fannie Mae to 10 loans. So what if you wanted to buy more? And so there's no limit to the number of DSCR loans that you can have. So that's another benefit. And again, with still no income documentation. So that's a really key feature. And there's also several different kinds of loans that you can get. I mean, generally you're 30-year fixed. You can also have interest-only options. So this is more maybe of a short term, a couple of years. You have interest only and control your cash a little bit better. You can also add prepayment penalties in order to lessen your interest rates. If you plan on holding this for a while, you can use a prepayment penalty in order to lower your interest rate and increase your terms. So that's kind of a tool rather than a hindrance for you as an investor. Also, DSCR loans offer good terms for first-time investors. That's like I said before. If you're just a homeowner and you want to buy that first investment property, I have some certain investors will allow a brand new investor. Certain investors will not allow certain kind of investors. So being a mortgage broker, I have multiple investors. I'm not held to one like other retail banks or just one option. Where it's for me, I can the sky's the limit for as much as out there in the entire market. Also, as I said earlier, there's certain property types which are problematic, like non-warrantable condos. Here in Florida, that's a big problem. Non-warrantable condos, certain things like condo hotels and things that, again, that Fannie and Freddie just don't want to securitize, they don't want to touch. So anything outside the box, you can use a DSCR loan to usually acquire anywhere from 1 to 8 units. Also, unlike traditional Fannie and Freddie conventional mortgages, a DSCR loan will allow you to take title in your LLC, corporation, or wherever you feel that you want to take title in. So it helps you preserve your asset protection strategies that you've already laid out. So you can take a title in any LLC that you can control, but ultimately, of course, you'd have to qualify for the mortgage yourself, because mortgages are written to people, not to companies, the mortgage itself, but you can take title in your LLC, which is another benefit of a DSCR loan. So a DSCR loan can be a fantastic solution if you're an investor looking to acquire more property for cash flow and make it easy to do so. At this point in the video, you're probably wondering what other videos I have about investment properties. So go ahead and check out this video right here.